Hi, I'm Mike Oliver, founder of Momentum Structural Analysis, and this is a yardstick, 36 inches long, today, tomorrow, forever.
It's also the reason we don't trust price charts.
When a contractor builds a house, he trusts that his yardstick is an accurate, objective, and an unchanging unit of measure.
Because if it weren't,
in the markets, these are our yardsticks. If the stock were trading at $40 a few years ago, is now trading at $44, we say it's increased in value by 10%. Objectively valid, right?
Wrong!
No, and that's the flaw in fundamental and technical analysis. When your yardstick is a fiat currency, it is an accurate, objective, or unchanging. Since 1959, we've experienced a 4,600% increase in money growth, 4,600%. But no analyst will mention this flaw that all their work is based on.
they're building houses that are doomed to collapse.
Oh my God, no, what are you doing? Please!
So how do we fix this? Couldn't we control for inflation by simply measuring against the Consumer Price Index? Well, if you believe that the CPI or any other government metric can accurately compensate for money growth, then you're welcome to the consequences. The problem runs much deeper. Asset price inflation and money supply growth aren't perfectly correlated over time, nor across asset categories. My solution begins with Bob Farrell, famous Merrill Lynch analyst, whose first rule of investing was, markets tend to return to the mean. We agree, but we've also observed that markets tend to oscillate the mean. A mean is a moving average of price, and if we measure price in relation to a moving average, then nominal price is no longer our primary concern. We're looking at market action in relation to moving averages and the structures it forms around them. This way we have a means of measurement that's primarily a function of the action of the market, not so much the constant distortions in the money metric. When we oscillate the price of a market around a mean, previously unseen trends and structures emerge. And now I'd like to introduce you to a couple colleagues so that you can better see what I mean by structure. Mr. Vandermellen has come here from September 1929 to tell us how he looks at the price chart of the Dow.
Yes, well, it's a healthy market. There have been some corrections along the way, some strong distribution in the first half of 29, but the buyers won. We've entered a whole new leg of the bull market. So I imagine that the Dow could easily reach 500.
Now, Mr. Skink, you've come here from September 1987. What do you think of your market?
Yeah, hey, Mikey, here's the deal. My chart guys, they tell me I got nothing to worry about. Now, they say they drew the trend lines, and the S&P could sell off at 290, hell, 280, I'd bet the whole ranch. I don't know about you, I buy in the dip. And here's the thing, I'm doing pretty well. Excuse me.
Now that we've looked at the price charts of these two markets just before their historic crashes.
Whoa. I stay rich though, right?
So now that we've looked at price, let's see what momentum would have told us. This is a momentum chart of the Dow Industrials from 1926 to 1929. It measures monthly price action in relation to the three-quarter moving average. Momentum agreed with the bull market's price action up until the final exhaustive spike in August 1929. Momentum did not confirm that new price high, which Mr. Vandermellen thought was a breakout and beginning of a new up leg. Instead, momentum was warning that the market was losing steam. Then when the three-quarter moving average jumped higher in October, 1929. Soon thereafter, the Dow broke below the massive momentum structure, and we all know what happened next.
I don't.
Well, what about 87? What about me? I got kids.
Mr. Skink, we saw the trend lines that your chart guys drew for you, and even the steeper trend line comes through so far below the market action it was basically useless. So let's compare this price chart to its momentum chart like we did with 1929. And we find the same massive momentum support structure, and also just like in late 1929, we find in late 1987 a new price high occurred in August that momentum did not confirm. Then, in October, when the three-quarter moving average jumped higher, momentum action soon thereafter broke below the massive three-year wide momentum structure. And we all know what happened next.
Well, I still don't.
In 1975, I was a futures broker at E.F. Hutton, and this was the first book I read on technical analysis. It was published in 1954 and remains the Bible of price chart analysis. In the intervening 63 years, there have been dramatic improvements in other fields. Things like 3D printing, microchips, cloning. But there haven't been any major revolutions in technical analysis. None, that is, until today.